So while currently I'm an Algebra 2 teacher, one of my previous careers, I was a CPA, and I practiced for 4 years. I'm still a CPA, just have an inactive license in the state of Florida, so we can't technically say you're a CPA. But anyways, so in college, I was a finance major, and one of the first classes I took was financial accounting 101, basically. And I almost failed out, right? I had a C, dropped the class. I was like, let me take it over summer. And I get through college. I didn't really do a lot of accounting classes. I get out, and then I go back to school and I do my accounting requirements, and it just took off. And then I ended up being, a really good accountant in my opinion. But what I realized is I didn't understand visually what was happening in a double entry accounting system. And so this is mainly for people who are new to accounting, or maybe you're really trying to up yourself to be somebody who does more of the journal entry system in your company. But I just kind of wanted to give you a basic rundown visually of what's happening in a double entry accounting system, and hopefully help you in your school or in your career. So when I think of the balance sheet, right, I think of assets, liabilities, and equity. Those are your three primary accounts. And I'm going to oversimplify this. But under the equity account, you have the net income part, which is going to be part of your income statement. And in that, you're going to have revenue and expenses. Now, the key is understanding your traditional debit accounts versus your traditional credit accounts, okay? And just to simplify, we've got debit is normally on the left, or sorry, not normally, and credit is on the right. So an asset account is typically debit, a liability is a credit account, an equity account is a credit account, and then inside the income statement, revenues are credits and expenses are debits, okay? So that's the basics of what's happening, but let's just run through some quick examples because I think it's easy to see. So let's say I go and I buy some computers for the company and it costs me $3,000. So on the cash side, right, assuming I paid cash, it's going to cost me $3,000. So I'm going to reduce, right? So it's usually a debit or a credit, it's usually a debit balance, but I'm going to reduce that side by 3,000, which means I'm going to credit that side. And on the other side is I'm going to put it in my fixed assets, which is normally an asset account, right? So that is a debit account, so I debit it for 3,000. That's it, okay? But let's throw something else in the mix. What if I said, well, I can pay $500 cash, but I need to put the rest on a credit card? Well, in that case, everything always has to balance in accounting. That's what's nice about it. So I'm going to debit my cash for $500. I still bought $3,000 worth of computers. Well, there's a problem because it doesn't balance. So 3,000 minus 500 is 2,500. But where do I put it? Well, I'm going to put it in a liability account, and I'm going to call that credit card payable, okay? And it's a liability account, which is typically a credit balance, which is great because I'm going to put it on the right side. So now my right side is 3,000, my left side is 3,000, and I'm perfectly in balance, which is awesome. Okay? All right, let's try another example. Let's say that you bought some inventory, and I think this is a good one because we're going to see a couple different moving pieces here. So I bought inventory of, let's say I own a company that sells shirts. So I bought inventory and it cost me $10,000. Well, I'm going to go and I'm going to debit let's say again that I paid credit. So I'm going to debit my credit payable, okay? And we said that that was a liability account. And a credit is usually a liability is a credit. So I'm going to credit. Running through debits and credits too fast, right? For 10,000. Well, if I put 10,000 in credit, I'm going to have 10,000 in debit to balance it. So I'm going to debit inventory, which is an asset account, okay? That I'm going to debit for 10,000. That's awesome, okay? Well, what happens when I sell those shirts? So let's say so this is A, all right, in B, let's say I sold, I don't know, $20,000 in shirts, okay? And we're going to assume, just for the sake of ease, that I sold all my shirts. Well, if I sold all my shirts, what happens is, all right, I'm actually now going to have 3 potential accounts. So I sold it for $20,000. So I got $20,000 in cash, okay, which is awesome. Now, I'm going to then, on the opposite side, right, because that's my debit, on the credit side, I'm going to have revenue of $20,000, right, which is awesome. Actually, we're going to make this a little lower because there's actually going to be 4 accounts. So I got in $20,000 and I count it as revenue. Okay, so that's an asset account, and it's a revenue account, which is our credit balance. Well, I need to get rid of that inventory. So the inventory was sitting on the books at 10,000. So I'm going to release that inventory. Okay, by doing that, I'm going to debit that side. And it's going to zero it out. Well, if I debit that side, credit that side, I'm going to debit this side. On this side, this is my expense account, all right? Or cost of goods sold. Again, I'm oversimplifying this, but in my expense account is now going to go up by 10,000, okay? And that's how you see how the income statement works. So we have revenue here, and then we have over here expense, and they net together, and so I have a $10,000 profit, right? So when I'm drawing out my accounts, if I'm not sure how they work, I like to just lay them out in T-charts because then I can see, all right, it has to balance. It has to be on the left or the right. And I keep this in mind as just my overall summary of assets, liabilities, equity, and then underneath equity, I have my revenue and my expenses, all right? And that's pretty much it. One final example in double entry accounting is when we have to do a journal entry. And so let's say at the end of the month, all right, I'm an accrual basis company, and I didn't pay for something yet, but I know I'm going to have to in the future, right? So maybe I earned it in that month. I'm trying to think of an example, or I'll give you an example. If I forgot to pay a bill, and this happened to me recently in a company that I own, I forgot to pay a bill. So that bill cost me $938. So to count for this, because the expense occurred in that month. I just didn't pay it yet. So what I'm going to do is I'm going to create a journal entry for that amount. Well, I know that I had an expense of $938. So I'm going to make the expense $938. Or in my T chart, right, I'm going to have expense of $938. And on the other side, I'm going to have a payable, all right? Because in the future, I'm going to have to pay it. Well, a payable is a liability, so it should be a credit. And those balance out. So I debit my expense for $938, and I credit my payable of $938. That's it, all right? If you want to see further videos like this, comment in there and ask specific questions, and I'll do more videos based around just kind of overall basics of accounting, double entry accounting system, debits and credits. One of the things I find with all my students in high school is they don't get anything like this. Everything is geared towards calculus. And a lot of what we do in the real world is we work in financial statements. And I think the more that we can add this, even at a younger age, the more that our children will be ready for what they will need in the real world. So even if you're a high school student, just take a look at this. It's really not that complicated, and I think it'll really help you. So as always, like and subscribe. And then, like I said, if you have any specific questions, put them in the comments and we'll address them in different videos. Thanks.